Because I think right from the start, for investors who hasn't been investing in Asia, we recommend them taking a more broader macro kind of a picture, having a broader market exposures into Asia. For those who have been into Asia, then you may have to start to be very selective into areas that you feel more comfortable. Perhaps if you feel that you are ready to go down the credit curve, moving from the sovereign to the corporate, at the same time, perhaps take a bit more currency risk. I think that is one area that we think that investors investing into Asian markets perhaps will need to leave the currency exposures unhedged. Now, I know that investors in fixed income typically would like currency hedged, but I think if you look at the Asian bond market in a total return perspective, I think it is worthwhile considering having that currency exposures. Of course, you need to be comfortable with some of the volatility. So I think in terms of the Asian investing for us, at this stage, I think investors should be gradually scaling in to invest in Asia if they haven't done so. And for those already in, if they are ready to take a bit more aggressive step in the areas that they feel that they have sufficient research done on it, I think that is also the time for them to do so.
The FX is a vital component to the investment decision in a region which has got burgeoning economic credentials and growth. This is often reflected in the FX rates that are derived as an indicator of an economy's health. So to leave it unhedged when purchasing a bond makes perfect sense to me. What we've seen is that there has been, in effect, buying the sovereign bonds in local currency of many of the regional economies. That trade's been underway for a long time. What we've seen ever more so in the past year is where investors are willing to look at the corporate market or the bank market denominated in Asian currencies. Singapore dollars, CNH, those markets in particular are very attractive. The maturities have been lengthening. The swap market liquidity has been improving. Liquidity is better generally. So institutional investors in particular feel that they can enter into those markets for a well-researched credit position. They can take advantage of the FX movement. And if need be, they can liquidate their positions and move out without undue stress. The maturity in those markets, Singapore dollars and CNH in particular, has been quite astounding this year. We've moved a long way very quickly. And I think this is part of a longer-term trend. And that by no means discounts all of the other local currency markets. We're seeing similar things, but to a lesser degree.
So you believe the trend will continue? It's sustainable?
Yes, I do.
If we look about the Asian bond flow, I observe if it's a flow from the West, sometimes the appetite is have towards the unhedged to the Asian bonds. But if it's because their currency is maybe is a bit shaky or on a depreciation trend, when we looking about the opportunity in Asians, we are normally looking for hedge. So for the regulatory aspects, the availability of onshore forward and cross-currency swaps of each Asian country is quite crucial in terms of development.